All right, so in the last video we discussed budgeting for cash receipts, and we looked at an example with a company that collected 60% of their accounts receivables in the month of the sale, and then 40% in the next month. So if that makes sense, it also makes sense that that same company, when they pay their bills, that they may not pay 100% of the amounts they owe in the same month that they incur the debt, when they create the payable. Okay, so just like with cash receipts, we have to create a schedule that shows us how we are spending our money and when we're spending our money. It says here on the slide that estimated cash payments must be budgeted, and that makes sense. If we're not going to collect all of our money up front, we're probably not going to pay it all up front. Most of our expenses are going to be related to the ordinary course of business: manufacturing costs, selling expenses, administrative, payroll is not listed, but that's a big one. Okay, we also have some other smaller items that are not part of the operating portion of the statement of cash flows. Well, I guess they would be in some of these cases, but interest payments, dividends, and so forth. Okay, we've got some investing activities here, capital expenditures, and so on. So when we look at this company, and again, we are going to simplify things just like we did with cash receipts, and we're going to be looking strictly at manufacturing costs. Okay, so we have the same 3-month period here, and we have some budgeted costs of $840,000, $780,000, and $812,000 for these 3 months. Now, because we're talking about compiling a cash budget, we have to recognize that depreciation, which is definitely an operating expense, we have to subtract that out because depreciation is based on timing. There's not an actual outflow of cash for depreciation expense. Okay, so that's a little bit of a fly in the ointment, so to speak, whenever we go to do this. Just like in the prior video when we talked about accounts receivable, now we're going to look at what our accounts payable were at the end of the prior period, December of, I guess, 2015, which becomes our beginning balance on January the 1st, and that's $190,000. We also have our little formula here. Looks like we're paying 75% of our manufacturing costs in the current period and 25% in the next period. So if we wanted to, we could merely take this $190,000, divide it by 0.25, and we could come up with what our budgeted manufacturing costs would have been for December of the prior year. I believe that would come to $760,000. So fairly consistent across all these months. All right, so you get the gist of it so far, and we're basically going to handle this the exact same way that we did our budgeted cash receipts, with this one little exception right here: less depreciation on factory machinery. So if we're, and also just like we did last time, we're going to look at the month of February. So if we do that, we had budgeted $840,000 in manufacturing costs for January. We're going to subtract out the $24,000 portion of that that's allocated to depreciation, and that gives us $816,000. Because we're looking at the month of February here, we're going to multiply that by 25%, and if we do that, we come up with $204,000 cash outflow in the month of February for expenses incurred, manufacturing costs incurred in the month of January. We had budgeted costs of $780,000 for February. We do the same thing. We subtract out that $24,000. That gives us $756,000. We multiply it by our 75% that we're going to pay in the current month. That gives us $567,000. We add these two figures together, and we're going to have budgeted cash outflows of $771,000 for the month of February. All right, so again, I'm not going to look at March, I'm just going to look at January in the interest of time. We said that at the beginning of the year, we had accounts payable totaling $190,000. That's what was left over from the month of December, and we're going to pay that in the month of January, so that is $190,000. We're also going to pay 75% of our $840,000 budgeted manufacturing costs for the month of January. I'm going to skip back one slide. If you don't believe me, there it is. Budgeted manufacturing costs for January were in fact $840,000. So if we take that $840,000 minus the $24,000 depreciation, multiply that by 75%, we're going to end up with $612,000. Plot that here. We add the two numbers together. Total payments for January would have been $802,000. We already calculated February, and if we do this a similar calculation, looks like we're going to pay out, or well, we're going to have budgeted cash payments of $780,000 for the month of March. So when we think about our cash budget, it is very, very intuitive. We're just going to say, okay, hey, you know what? We're going to take our estimated amount that we have cash coming in, our inflows. We're going to subtract from that our outflows. And that gives us either an increase or a decrease in cash. It just depends on which one of these numbers is bigger. We're going to add to it any cash that we had at the beginning of the month. And if we do that, we now have our cash balance. Okay? And by the way, our cash balance at the end of this month does become the beginning balance for the next period. Now, this is where, if we're going to really talk about this from the perspective of management planning, we have to account for that minimum cash balance that we want to have. We subtract that minimum cash balance out from the cash balance at the end of the month, and what we're going to find is that we either have some excess cash or we are deficient in cash. And quite honestly, we don't want to have too much excess cash on hand, and we certainly don't want to have a large deficiency. Okay, so this is a part of the overall planning process, making sure that we have enough cash to operate, but not so much cash that is just sitting around idly doing nothing for us. Okay, so looks like we have here, we're trying to determine, looks like our cash balance for the end of the quarter. We have a beginning cash balance up here of $225,000. We have some expenses that we have recorded related to, looks like quarterly taxes, interest expense. Then we had some revenue, $24,500. We bought some equipment, had a large outflow. Now, I'm not sure if this is cash or not. We're going to find out in a minute. And then we had selling and administrative expenses that were paid in the month incurred, $160,000, $165,000, and $145,000 for these 3 months. Okay, so that's kind of a snapshot of some activity that we had. Let's go ahead and look at our completed cash budget here on the next page. We have first our estimated cash receipts for the 3 months. We had that unusual item of interest revenue, and we only collected that in the month of March. So we don't have anything for January and February. So we have our total estimated cash receipts for these 3 periods. We're going to do the exact same thing for our payments right here. We looked at our manufacturing costs with the schedule, and then we said that we had the selling and administrative expenses that were paid as they were incurred. It looks like our capital additions, the sewing equipment, was paid for in cash, all in the month of February, and we had an outflow of $22,500 interest expense only in the month of January. Okay, and then we skip down to item 15. We paid some income taxes of $150,000 for the first quarter of the year. So if we do all of that, we have our total cash payments for the 3 months. That's just these 3 figures added up, okay? And then these 3 here for the month of March. Up here we have our cash receipts. Our increase or decrease looks like in the month of February, our cash payments were $1.21 million. And yes, that would be $34,000 more than what we received up here. We have our beginning cash balances for each month. We have, let's see here. I'm sorry, for the beginning of each month and then the balance at the end of the month. So yeah, it went down for February. We also have our minimum cash balance. Looks like they want to have $340,000 of cash on hand at all times. And so if we account for that, it looks like we have excess cash in both January and March, and then we have a deficiency in February. Okay, now 28.5 excess cash, based on what I'm seeing here, is probably okay. We don't have a ton of excess cash sitting around. If we were to put a 2 here in front of this, we may have a problem, but this looks like a pretty good cash budget. Okay, so everything else after that is a couple more examples from your textbook. And so actually those are not from your textbook, but you can look at those examples in the PowerPoint, and hopefully those will help you with the cash budgeting process. That concludes the video PowerPoints for budgeting, and you will have your 3rd handout that you can work out along with the videos from that handout.